The fact that Stretch is trading near par at the time of the earnings call, really what that says is there is a degree of confidence in their ability to manage this product in a responsible way and in a way that investors can trust. And so this is really the stress test that strategy really needed.
His comments really get to a criticism I see a lot. They don't do anything. They don't have any operations. They don't have a product. What this shows empirically is that this is the product. It works so far pretty well in that they've been paying the dividends, and the value has been very stable relative to Bitcoin's value. Welcome to the Bitcoin for Corporations show. Today, it's just Spencer and I. I'm your host, Pierre Rochard. We're going to go and take a retrospective on last week's MSTR earnings call, kind of highlight some of the major themes and give our commentary on it, because I think it really is a historical call in the sense that, we've got earnings calls from the bull market, and now we've got an earnings call in the bear market. And so we can really see what the approach is for strategy when Bitcoin conditions are negative.
Yeah, absolutely. I think a lot of people in the space were really curious to hear, first of all, the tone of Saylor and Fong and Andrew Kang, et cetera, on how they were going to talk about strategy. I think it's no secret that there has been a pretty large drawdown in the common equity. But I think that the underlying theme in this call is that they're continuing to bang the drum on their perpetual preferred equity and their digital credit products. And I think that really worth digging into. And I think they also provided some pretty interesting forward guidance and projections on where they see this space developing. But yeah, I think it couldn't have come at a better time. I think, strategy's been in the midst of a drawdown before during Bitcoin winter. And this is perhaps a little bit more temperate of a winter, but I think with moving away from convertible bonds into this digital credit space, I think it's we have more things to discuss, and surely the strategy team delivered.
Yeah, and you mentioned that they've been through this before, and I think that's actually a really important point, which is that they learned a lot from the previous bear market that they went through, and so that went into their product design and their risk management, so that when a bear market comes back, that they are positioned to not break. There's like a lot of FUD on social media of people saying, "Oh, Saylor's below his cost basis, and so that means he's going to have to like liquidate all the Bitcoin. He's going to get a margin call." Uh, they learned to not have margin calls and liquidation clauses from the previous bear market, and so I think that there's still an information asymmetry between what people think the fragility of strategy is versus what it actually is in practice. Now, obviously, it's not perfect, right? I think in that call they mentioned, like, if Bitcoin goes down to $8,000 for the next 5 years, that would be a problem. So it's not risk free, but I think people's mental model of what the risk is and what the probability distribution is sometimes not as accurate as it should be. And I think that they did a great job of setting the record straight, of pointing out not only have they embraced perpetual preferreds so that they don't have that maturity risk of the convertible notes, but also that they have developed a cash reserve. And that was, I think, the big development over the past quarter. And, some people might view that kind of controversially of, hey, this whole experiment started with the melting ice cube of Bitcoin, of fiat. And so why are you holding a fiat reserve? And it really comes down to the credit rating of the company and improving that. And I think that's going to be the big theme going forward, is that they've got a credit rating in place for the company of B. I think that they could get an A. I don't know how long it'll take, but they're taking the right steps to be able to accomplish that. And that will actually accelerate the flywheel of people, their credit products having more demand and enabling them to continue to increase the amplification.
Yeah, I think the piece on the credit rating is really interesting because on the one hand, it is a matter of practicality. How much cash do they have on hand? What is their entire the calculation of their total assets, what are their liabilities, and how much coverage do they have. But then on the other hand, it was S&P's methodology where they provided a really steep haircut to their Bitcoin as an asset. And so I think, yeah, again, on the one hand, it is what are the mechanics of their operating business and their liabilities, but two, what are the mechanics of the agencies themselves and how they approach Bitcoin. And before we jumped on the air, that was something we discussed was, where is the space that exists around Bitcoin and strategy going? And I think that can really inform where the space itself within Bitcoin will be headed. So I do want to play a brief clip for the audience here, and we can discuss a little bit following.
12 months ago was almost impossible to get a loan or a margin loan against IBIT. Now there are many banks coming into space. Would they let you trade BTC? Now you have banks that are announcing support for that. You have banks announcing support to custody BTC, and you have banks announcing intent to offer credit against BTC. Again, this is an extraordinary sea change. We cannot underestimate the value. I think that the fundamentals of the industry are driven by the banks creating credit. One bank can create as much credit as all the Bitcoin miners can create in Bitcoin in a year. So each bank that turns on Bitcoin-backed credit lines might be the equivalent of another halving for the network. Let's go to the next slide. TradFi and FinTech have embraced Bitcoin. If you look at the number of accounts with BTC trading asset, there's a pretty clear bullish trend here, both across crypto native exchanges, FinTechs and neobanks, and the brokerages and banks and the wealth management channel. Those are large numbers. Fundamentally, we're going from an asset class that no one could buy if they wanted to an asset class where everyone is competing to facilitate access and exposure.
Yeah, so I mean, I think, but again, before we jumped on the air, Pierre, this is something we were discussing was, I think in the context of your speculative attack thesis is, what is this end game for companies issuing credit with Bitcoin as collateral? And what is the growth of something in particular like IBIT and the other Bitcoin ETFs? What does that mean for both the growth in the Bitcoin price, but also the denominator for Bitcoin when you're calculating it in dollar terms? Like, how does that play out in terms of the monetary policy and overall just M2 expansion that we very well could see as a part of this dynamic? But was hoping you could dive into that a little bit.
Yeah. So at a high level, you could actually model the financial system in two parts. There's the bank credit, and then there's the non-bank credit. And so non-bank credit has actually been growing a lot over the past decade. Before the financial crisis of '08, and afterwards, the skeptics called it shadow banking. And kind of tried to make it sound like it was some crazy Wild West. But the industry has really, and combined also with the leverage buyouts and kind of all of that dynamic that created a lot of this non-bank credit. And you could add to non-bank credit, for example, futures margin, right? So it's CME. You could also add options, which are a form of leverage, right? So there's all of these instruments that allow people to lever up against Bitcoin. And then if you look at the bank credit side, what we're really talking about is the commercial banking system. And that is what is the fractional reserve banking system, right? That is connected very closely with the Federal Reserve and tightly regulated by the Federal Reserve and by the FDIC and by the OCC. And this commercial banking system, it has to be heavily regulated because if it's not, what happens is bank runs, right? And if you look at the economic history of the United States, there have been bank runs throughout U.S. history, and they, in the worst case, in the Great Depression, were attributed for a very negative economic outcome. And so after the Great Depression, that's when this whole kind of system came together to bail out the commercial banking system on one hand. On the other hand, to limit its risk taking in order to minimize the bailout liability. And so it has gotten tighter and tighter in terms of its risk controls to try to minimize the risk of bailouts. But nevertheless, as we saw with SVB, it's just inevitable that there's going to be blowups that require monetary authorities to step in and create dollars to bail out. But also, even outside of kind of a crisis scenario, they create dollars day to day every time they lend out money. So this is, what Stephanie Kelton and kind of the modern monetary theory people, I think that they're actually very astute at analyzing this part of the system, even though they have a lot of trouble integrating it into a wider macroeconomic coherent framework. But when the banking system creates, for example, a mortgage, they're not borrowing dollars from one person in order to lend dollars to another person. They're just printing those dollars out of thin air. And then they're managing their capital requirements according to kind of the regulatory framework. And so when we think about speculative attacks, there's really two kinds of speculative attacks that we could look at, given that we've got non-bank and bank credit. So non-bank credit can be fuel for a speculative attack, but ultimately there's not a reflexive feedback loop because you're not creating new dollars. The ideal speculative attack involves creating more of the weak currency, right, by borrowing it from the commercial banking system in order to buy the strong currency, which in this case would be Bitcoin. Wait until the exchange rate goes in your favor on the strong currency, and then sell the strong currency, pay down the loan to the bank. And so that is a vector that doesn't really exist today because the commercial banking system is not in a position to lend against Bitcoin today. Now, because of the victory of Trump in the previous presidential election and his interest in making the United States the Bitcoin superpower, he has put in place financial regulators who I believe are going to actually unlock access to the commercial bank credit system for Bitcoin borrowers. And that's going to happen gradually, right? It's not going to be like overnight. You go to JP Morgan Chase, deposit 1 Bitcoin, borrow 50% LTV, right? But I think we'll get there. And that as we incrementally move towards that world, the value of Bitcoin, right, the price of Bitcoin in dollar terms is going to skyrocket because of the imbalance between the abundance of US dollars that can be created. And, there's only today, I think, 19 million Bitcoin. Almost all of the Bitcoin have already been mined. You can't, increase that fixed rate schedule. So that supply and demand imbalance, I think, obviously hugely bullish for Bitcoin. And that's why I think that Saylor kind of pointed his finger to this area that is underdeveloped of Bitcoin-backed bank credit.
Yeah, and do you have any thoughts on what form that that Bitcoin collateral will take? I think that's been a topic of conversation in the Bitcoin space. Is this going to be multi-sig custodial Bitcoin or like MPC Bitcoin held by these custodians, or is this going to be like so an individual could deposit Bitcoin with a commercial bank, or is this going to be something like you have a brokerage account with IBIT in it, and it kind of takes this more custodial form? Do you have any thoughts on if Bitcoin will be used itself, or if it's going to be used in more of a custodial fashion for this type of operation?
Yeah, so my crystal ball can only go so far in the future. What I can say about the immediate future of where this is beginning, it's actually really interesting. A press release came out yesterday that Ledin, a lender against Bitcoin, it has actually secured a preliminary credit rating from S&P for their loan book that they are securitizing. And what that means is that now a commercial bank could actually buy a slice of that loan book that has a credit rating on it without really needing any additional, you know, support from regulators, right? Because it's kind of they've checked all the boxes here, and so I think that what we're going to see develop first is that commercial banks are going to lend to Bitcoin lenders, and Bitcoin lenders are going to lend against Bitcoin. So whatever products exist today, what we're going to start seeing is that their interest rates are going to start coming down. And so some of those are multi-sig, collaborative custody. Others are really, fully custodial. But we might start seeing new models that this enables, where you could have, for example, you hold your own Bitcoin. There's no custody by the lender, but you're pledging that Bitcoin and your credit rating, right? So your TradFi fiat, 800 credit score or whatever it is, and that the combination of those two mean that okay, this person has a stable job, they've got assets, they've got homes, businesses, the securities, Bitcoin. We can lend against all of that, and we know that they're going to be good for it. And so, kind of widening the collateral base in a really holistic manner, I think so. I think that's kind of where we're heading, and that we might eventually see, apps like, for example, Cash App, right, where you might have your TradFi stonks in Cash App or in Robinhood, and your Bitcoin there, and that you can borrow against them as a whole, right? You're not like borrowing against Bitcoin specifically; you're just borrowing against your portfolio. And so I think that there's going to be lots of innovation at the retail consumer level, but also at the institutional level, right? So we can kind of draw a straight line to say, okay, as Saylor improves the credit rating of the company, lowers yields or dividend rates on Stretch very gradually, right? In case Lawrence Lepard is listening, this was his question about, are you going to rug us on the dividend rate? And Saylor's answer was no, unless there's too much demand for digital credit, right? And I think that's the right answer. So at the institutional level, I think that we're going to start seeing more and more activity for borrowing and lending against Bitcoin, kind of in large chunks, right? Not at the retail, and that those rates are going to come down. So that's eventually we'll see JP Morgan Chase start, they'll I think they're already lending for high net worth individuals and kind of private clients. So they're going to start with the most conservative approach, but they'll eventually open it up to where you'll be able to access it pretty easily.
Yeah, I think last time we discussed the Q3 earnings call for strategy, we talked about digital credit spreads, and Saylor did offer just a little bit of discussion on where he sees those going. And I think that it was really important in this most recent drawdown to see how those performed. I think it's a really good bellwether for the space, and I think kind of a proof of product in many ways. So I want to go ahead and roll that clip, and we'll discuss after that.
How do we benchmark ourselves against the other credit alternatives? Well, the bank accounts might give you 40 basis points. The money markets are giving you 360 basis points. Taxable. Insurance companies don't pay tax and endowments don't pay tax, but actual real people, families do, private companies do, public companies pay tax. The world's full of people that have to pay tax. And so 360 basis points of money markets, works out to might be only 180 basis points if you live in New York or California after tax. So clearly what we have here is a yield-starved environment. The base rate and the risk-free rate is 360 basis points taxable. And that means that all the conventional credit instruments are pegged to that, like mortgage-backed securities, investment-grade bonds, junk bonds. They all trade at very small premiums or spreads over that risk-free rate. And STRC is paying 11.3% at par, 11.25% at par. And so you can see here that it's 3 times more on a pre-tax basis, but on a tax equivalent basis, it's like a bank account in Miami that pays you 18%. It would be much more. It'd be like a bank account that pays you 22 or 23% in New York City or San Francisco. So we think we've been able to create a very compelling credit instrument versus other credit instruments. It's just 2 to 4 times better. Here's an actual 4-month snapshot. And this is an interesting comparison, Stretch versus Bitcoin. What's the difference between credit and capital? Well, in the last 4 months, Bitcoin has traded down 30% through the 1st of February, Stretch is up 1%. And so it doesn't take a rocket scientist to look at this chart. If you're a retiree, if you're a corporate treasurer, if you're a fixed income investor, if you're any kind of investor, and you look at these two charts, if you're crypto curious or you think you might like Bitcoin, you look at this and you think, well, I like it, but I just can't stand the vol. You can see why. Do you want 30% drawdown and no dividends, or do you want 1% price appreciation and 5.3% paid dividends with an ongoing 11.25% dividend rate, and with the company that's making a commitment to stabilize that price to target 100 and do whatever it takes, including raise the dividend?
Yeah, so I think looking at this, we can definitely see that the fact that Stretch is trading near par at the time of the earnings call, I think, first of all, says a lot given the really, really steep drawdown in Strategy's equity and Bitcoin, of course. But I think also it shows that as they've had to adjust upward the interest that they pay on Stretch, I think that that kind of the forward guidance Saylor has offered, the fact they've built up this cash buffer. And I think really what that says is there is a degree of confidence in their ability to manage this product in a responsible way and in a way that investors can trust. And so that was my read on this, is that this is really the stress test that Strategy as like a almost a digital bank really needed. And I also think along those lines is, earlier this year we discussed Strategy as this kind of pseudo central bank of the future. And if you looked at the effective dividend yield that Stretch has, it was around, I think, 18% that say they were just discussing. And I'm reminded of Paul Volcker in the 1980s, where he had to jack rates up to about that 18% mark, and we saw a 40-year bull run in the bond market. I almost think, is that going to be a similar trajectory where we have kind of this 18% effective yield, and we're just going to slowly creep downward and kind of engage in this bull market for Bitcoin-backed securities? Like, I think that could be, I think, a fruitful thought experiment for how that plays out and when that plays out. But yeah, I guess, Pierre, your thoughts on what we've seen over the last, say, since October 10th until now, in terms of how these perpetual preferred equities have performed, and what you thought of Saylor's comments around that.
Yeah, I think that his comments really get to a criticism I see a lot of Strategy and of Bitcoin treasury companies in general, of like, they don't do anything. They don't have any operations. They don't have a product. How do they make money, right? And I think that what this shows empirically is that this is the product. This is the product. It works so far pretty well in that they've been paying the dividends, and the value has been very stable relative to Bitcoin's value. And so there's been demand for more, right? So they've been able to follow on with additional issuance through the ATM. We also saw news from Strive. Full disclosure, I'm an independent board member there, but it was announced that they had a second offering for their SATA product, which is much similar to Stretch in its design. And so clearly there's continued demand for the digital credit product, and that. Why is that, right? Like, as Bitcoiners, I don't think that any Bitcoiner has kind of missed out on the explanation that Bitcoin is too volatile, right? That's maybe the number one objection to Bitcoin. It's not the carbon emissions. It's not like anything else. It's the volatility. And I think that for a lot of us, it's not an issue because we're young, we're tech savvy, We're risk seeking. So we just can't relate to somebody who is needing a steady cash flow, needs steady income, and is risk averse and doesn't want to go up 1,000% and then down 90%, right? Like, even if the end result is better, the path to get there is just horrifically painful for people who don't have the same, views as we do. And so I think that's really the bridge that Saylor is building, is between those very conservative people on one hand, and then on the other hand, there's people like who want to outperform Bitcoin. So historically, they were like gambling with altcoins, or I don't know, investing in Bitcoin mining, like trying to find angles to outperform Bitcoin. And now they kind of have a cleaner vehicle to do that with the equity of these Bitcoin treasury companies that are levered up or amplified up, because if they're bullish on Bitcoin, that mechanically is going to outperform Bitcoin. With the caveat that it depends on at what MNAV you're buying, right? So right now, I think MNAVs are hovering around 1. So it's kind of hard to understand the bear case other than like just being outright bearish on Bitcoin itself. And so, I thought that was a really great chart to compare the volatility of Bitcoin to the volatility of this new digital credit products that he's developing that are backed by Bitcoin, but very different from Bitcoin, right? And so that's worth repeating at every opportunity.
Yeah. What comes to mind for me is that Saylor is developing this multitude of horses for courses, and what I mean by that is that you have people that are looking for Bitcoin outperformance. They're willing to withstand massive drawdowns in search of, again, that Bitcoin outperformance. But you also have these various perpetual preferred equity products that have various dividend rates on them, and they also have different volatility profiles. And I think that I think he said it himself. This is a gateway for the investing universe to get into Bitcoin at, I think we often say the price they deserve, but also at the volatility that they want. I think that that's a really, really interesting product market fit. And it has me thinking about what is the use of Bitcoin in a society, our society today. Does it make sense for the everyday individual within the United States to be using essentially nuclear grade payments technology, handling their own keys, or does it withstanding the volatility? I think history would show that a lot of people can't withstand that volatility. It's not to say that they don't have conviction in the asset. It's more to say that they have a timeline mismatch with the volatility of Bitcoin, and we do see people sell the bottoms. Unfortunately, all too common. And so I think that the bigger picture around strategy and what they're doing is they're giving people like kind of this dose of Bitcoin at a level that I think is salutary to their investing goals. But I think it raises the broader question of, will everyday individuals be investing in Bitcoin, or will they be investing in these Bitcoinized equity products, and what path does that take going forward?
Well, and they have the choice, right? And they can do some combination thereof.
Hmm.
But I think that freedom of choice is crucial if we really want to broaden adoption and to accelerate Bitcoin adoption. Like, I know that some people say like buying Stretch is not Bitcoin adoption, and maybe it's not to you, but to somebody else it is. And so we have to kind of embrace that subjective theory of value combined with just how different people are. Um, so, because if we think about a thought experiment of how could we get full self-sovereign adoption of Bitcoin, right? Everybody's holding their own keys, everybody's running their own node. Set aside the scaling question. Let's just assume that's solved, right? Bitcoin fully scales to 8 billion people. How do we get everyone to adopt Bitcoin at the base layer? We would have to ban everything else, right? It would literally be illegal for you to use a third-party custodian. That's the only way we could get there. Or that if you use a third-party custodian, you'll get rugged 100% of the time. And so that's how you make sure that people are holding their own keys. And that's not really, that's kind of dystopian, right? That's saying that society has failed. And so that's why we have to use the Bitcoin base layer and everybody has to use it. Versus today where anyone can if they want to. A lot of people might feel like they don't need to because all they're looking for is financial exposure, whether it's IBIT, MSTR, stretch. Like they're not looking for self sovereignty. They already feel self sovereign enough, or they already own Bitcoin that's already self sovereign, and they've kind of satisfied that marginal desire for safety. And now they just want to diversify their Bitcoin exposure across different media. And that, we could make an ideological purist argument against it, but that's what that argument will always remain, ideological purist argument, right? Which is totally fine. Pragmatically, it's not predictive of what's going to happen. And that is my biggest criticism of it. It's not that it's, bad. It's just that I don't think that's what's going to happen.
Yeah, I think this is the core of the debate between kind of the puritanical Bitcoin outlook that I think is attractive in terms of virtue signaling and marketing. There's a certain allure to it, but I think in practice we see individuals need different tools and have different applications for Bitcoin in their lives, and I think that this is exactly how that plays out.
I just want to ring fence it because you can also be a Bitcoin Puritan with regards to the digital asset treasuries and kind of the wider ecosystem there, where just not to pick on them, but Ethereum has been completely revising their roadmap, right? So I was just listening to our friends at Bankless on their podcast, and you can't apply all of the same principles of Bitcoin to all the other cryptocurrencies, because ultimately you do need that backstop of fixed supply, 21 million Bitcoin, super reliable, decentralized network, and that all of the financial engineering is downstream of the software engineering. And I think that that's also something that needs to be emphasized. Otherwise, it kind of turns into a funhouse, of mirrors, smoke and mirrors type stuff. So yeah.
I think if Bitcoin is going to be the hurdle rate, going to be this base layer collateral, I mean, I think it's been designed in such a way, and you look at other digital assets, and they're trying to put the cart before the horse in many ways when it comes to achieving that outcome. So I think the tape will tell, but I won't be waiting with bated breath. I think we feel pretty strongly about the fundamental qualities of Bitcoin versus other assets. And I want to kind of shift gears here and go into some comments that Fong Li offered in this earnings call. I think he provided some interesting guidance on how they see their dividend rates going into the future, and kind of their projections for strategies equity performance in the context of a changing interest rate environment from the Fed. So I want to go ahead and roll that, and we'll discuss accordingly.
The way we're going to increase Bitcoin per share over the course of the next 6-7 years is we are going to sell digital credit. And what does digital credit do? By selling digital credit, we generate amplification. By generating amplification, we increase Bitcoin per share. By increasing Bitcoin per share, MSTR common outperforms Bitcoin. It's a very simple formula. And what are the inputs? How much digital credit can we sell? Which is how much stretch can we sell? Here's an assumption that on a base of $60 billion of Bitcoin, if we can sell 10% of digital credit, which is $6 billion, this is what this might look like over time. And you say $6 billion, is that a lot or is that a little? Well, last year we sold $7 billion of digital credit, and we raised over $25 billion in the equity capital markets. So we think this is a fairly conservative assumption, $6 billion. This assumes a 10% dividend rate, which is where we are right now, and that we're issuing equity to pay for the dividend on digital credit at 1.34x MNAV, right? And so I'll call this a low scenario. If we have this low scenario over the course of 7 years, we'll increase Bitcoin per share 1.4x. That's a 5% annual Bitcoin yield. Next slide. What if we can do a little bit better? What if we can assume 16% of digital credit sales? So not $6 billion, but $10 billion. What if the Fed lowers interest rates, or we're able to lower interest rates on our digital credit down to 9%? And what if the view of this causes investors to believe we'll increase Bitcoin per share and our MNAV goes up and we have amplified Bitcoin and MSTR, and we're able to get to 1.75x MNAV? This scenario with a assumption of 30% Bitcoin ARR gets us to a 2x increase in Bitcoin per share over 7 years, which is a 10% annual BTC yield. Next slide. What does a more aggressive scenario look like? Maybe we can assume 20% digital credit sales. We're able to drive the dividend rate down to 8% and our MNAV goes up to 225. Then we can increase Bitcoin per share 2.5 times over 7 years and a 14% annual Bitcoin yield. That's another scenario. And I'll go to the final slide of my section. Ultimately, this is the strategy of the company. We're going to issue digital credit through Stretch. We're going to amplify the common equity because of it. It increases our Bitcoin per share and we outperform Bitcoin. What are the levers that we can play with? How much digital credit can we sell? How attractive can we make Stretch? How well do we market it? How well do we distribute it? With higher demand, we can lower the cost of credit and we'll increase the MNAV. That's the thesis for the company, and that's what we're excited to do, and that's what we're going to focus on in 2026.
Yeah, so that was Phong Le, CEO of Strategy, giving his kind of guidance on where he thinks their future projections with regards to digital credit and their Bitcoin per share lie. And I think that one of the interesting assumptions underlying this is what are the credit spreads on digital credit? How does this relate to the Fed funds rate? And so I think there's a lot of knobs we can turn, but I think ultimately what this shows is that this is a relative to all other instruments in the Bitcoin ecosystem in investing broadly. I think that this is the kind of risk minimized means of outperforming Bitcoin is through this increasing Bitcoin per share through the issuance of digital credit, ATM issuance as well to fund that. But I think that looking ahead, if you increase your Bitcoin per share by 100% over 7 years, like that is some extremely significant outperformance. And I think that's something that people, uh, the mechanics of that, I think people discount when, if say a critic of strategy will discount that to zero and just say, oh, he's diluting the equity. You need Bitcoin to moon to see any outperformance. And I think that, if you see an increase of 100% over 7 years in just the Bitcoin per share, that's your outperformance right there. And so, I thought Phong, first of all, important to make that pitch, and really the important piece that he mentioned at the end, I think, is the marketing of this. How do you get the target audience to understand what it is strategy is doing and how that applies to their investing goals? And that was something, Pierre, you asked on a recent earnings call, was what are strategies plans related to marketing? I know they've been on the road, the kind of the Bitcoin digital credit roadshow, so to speak. But Pierre, do you have thoughts on what Phong had to say? But I think in particular would like to hear how you think about the marketing of these products, especially given your work with Strive.
Yeah, absolutely. So I think that on in terms of where it's going to go for rates, I think that's a really interesting question when we look at the Federal Reserve and the new appointee there at the Federal Reserve, Kevin Warsh, who has actually said some pretty Bitcoin friendly things historically. So that's really promising. On the rates, though, I think it's there's a lot of uncertainty about where rates are going to go over the next 12, 24 months. And so I actually think that, to talk about the Bitcoin price what's causing it to crash, I think it's all this uncertainty around rates and what Kevin Warsh is going to do. Because there's really strong arguments in both directions of he's hawkish or he's dovish. There's a lot of mixed economic signals. And I think that is due to AI. And so you could see, for example, a very weak labor market because everybody's hiring agents, but very strong GDP growth because these agents are insanely productive, right? So you can actually, when we think about the Federal Reserve's dual mandate between GDP growth, inflation, employment, that's actually, I think, all up in the air right now. And that's the kind of uncertainty that drives Bitcoin price down, right? So once the certainty forms around what's coming next, that's where we can start thinking about some different scenarios. So one scenario would be that essentially Kevin Warsh starts lowering interest rates and easing credit conditions. Right now, liquidity is a little bit tight. If they have a view that AI is going to be hyper deflationary, and so we don't have to worry about inflation anymore, then we got to really make sure we maintain full employment. There's a midterm coming up. There's obviously the next presidential election. They'll want to keep it Republican, and so I think they could run it hot. But if they're right and inflation doesn't really tick up, what does that look like for Bitcoin? I actually still think Bitcoin will do very well. If we look at Bitcoin's price history, even when inflation was low, for example, before COVID, it still obviously did very well, right? We went from $0 to, let's say, before COVID, like $20,000, right? In a matter of years. So I think that Bitcoin could still do extremely well, even if we don't have, double-digit inflation and we just have 2% inflation or 1% inflation, because that combination of the money printing with the increase in productivity just nets out to 1 or 2%. So I think that could be hugely bullish. Then combine that with a different scenario would be that all of these investments in AI eventually achieve diminishing marginal returns, and they overbuild infrastructure. It's over indebted, and they can't pay off the loans that they spent to build trillions of dollars worth of data centers and other infrastructure. And this is what happened with, for example, fiber optics with the .com bubble. Right? They overbuilt fiber optic cables. Then there was just a massive glut, all this dark fiber. We might start hearing about dark GPUs, right, that are just turned off because there's not enough demand, because maybe the software gets better and better, more and more efficient. Or people start doing inference at the edge, right? The models get so good that you don't need to do inference in the cloud. And so, but that's just a scenario, right? So there's all these different scenarios that could play out. And that's the uncertainty right now that I think a lot of allocators are experiencing. I think that ultimately in the most uncertain future, you want to hold the most certain asset. And that's why I think that the fundamentals for Bitcoin are getting better every day. TikTok next block, we're going to use AI to fix the quantum problem. Let's touch on that. It's going to be, I think, maybe laughable in hindsight. We'll be like, oh, remember when we were worried about quantum? And then, we told ChatGPT 11 to one shot fix it, and it does it. It's like, okay. So yeah, that's kind of my read on. Then, of course, how does that impact strategy? Well, if they cut interest rates and that improves conditions for Stretch, because even if Stretch does not cut its interest rates, now the spread is increasing, right? So the opportunity cost of not being in Stretch increases. And then combine that with a bullish price path for Bitcoin. Obviously, that would be hugely beneficial for strategy. And a lot of the bears who have been gloating and posting price charts of, from the all-time high of the yacht party in Miami, New Year's Day to today, which, it's a pretty ugly chart. But we'll have the opportunity, I think, in the future to show a different chart that kind of shows how wrong they were to be gloating when they should have been accumulating, whether it's Bitcoin or MSTR or anything else.
Yeah, I, for one, look forward to the second 100K party. I think the comeback will be even sweeter. And I think on your point around uncertainty, I think that's a perfect segue into our next topic of discussion that you alluded to as well, is kind of the quantum FUD. And I was somewhat surprised to see Saylor speak about this on the earnings call, offering his thoughts on quantum and how strategy wants to help address this topic of conversation. And I think what this shows too is that he is getting a signal that investors have concerns about this. I think that otherwise, this would be a topic of non-conversation. But I'll go ahead and roll this, and we can discuss accordingly.
The concern du jour is quantum computers, and many people ask, do quantum computers represent a threat to Bitcoin? I would note that the quantum computing concern and quantum FUD is just the latest in a long litany and a parade of horrible FUD that has been taking place since the beginning of Bitcoin. There was functionality FUD. Bitcoin's not functional enough, so it will fail. It needs smart contracts. And then people thought it was a Ponzi. And then they thought it was too volatile. And then they thought, well, there was a bug in it. And, maybe it'll be 51% attacked. Maybe the Chinese control too much of it. And then there was the Chinese shut it down. It was the opposite of the China FUD. It was the China non-embrace. And then we had all manner of block size wards and bandwidth FUD, and then there was it uses electricity FUD, and then there was the wealth concentration FUD, and then of course then there was another crypto will be better. What I would say is whenever dealing with each of these concerns, we have to take them seriously. We have to consider them, but we have to remember two things. One, the two words on the back of the Hitchhiker's Guide to the Galaxy: don't panic. Most important two words, more important than everything in the encyclopedia or the Hitchhiker's Guide to the Galaxy. The second observation, the Hippocratic Oath: do no harm. And so whenever you're faced with a challenge in any system or any network, you have to make sure you don't panic. You're not railroaded into doing something foolish or destructive. And you also can't do something that causes harm. You don't want an iatrogenic intervention where the cure is worse than the disease. So our position on quantum computing: one, we think it's probably 10 or more years away before there's a threat. That is the consensus. It's a promising technology, but it's still nascent. Many industries, including finance and defense, are dependent upon traditional cryptography. They face the same risks. There's a significant global investment going into building quantum-resistant protocols, not just in the Bitcoin community, across all communities. The Bitcoin community in specific is engaged on research and development in these efforts. There's good work that's taking place. If Bitcoin requires an upgrade, there will be global consensus. Right now, there isn't global consensus that existing cryptographic libraries are at risk. And to stampede into a hypothetical fix before there is consensus would introduce new attack surfaces and new complexity and new failure modes that don't currently exist. It's very similar to over-vaccinating, when it's like, well, there's a 0.001% chance that the kid might get a disease, so we're going to vaccinate them just in case. But of course, 3% of the people that get the vaccine have side effects, right? And so it's very important that we don't over-insure, over-vaccinate, over-treat, over-worry. It's a famous president of the United States. He said, if you see 10 problems driving down the road, 9 of them will probably drive themselves into a ditch before they get to you. So the one thing you can't do is you can't buy 100 expensive insurance policies that cost collectively 100% of all your operating income to insure against something which is 2% likely to happen. That's why you have to be very thoughtful about addressing these risks, and you have to address them at the right time, not too soon, not too late, but because too soon, you probably don't have the right technology and you're over-insuring. Too late, right? You accept the risk that you shouldn't. That's why consensus is very important. Bitcoin will be stronger if and when that quantum upgrade takes place, right? And so Bitcoin is upgradable, and Bitcoin can be upgraded to be stronger. And we, of course, are optimists, and we believe that the human race will accept challenges and will upgrade to meet those challenges and do it in a rational fashion. And Bitcoin has a history of meeting challenges in a rational fashion such that it is stronger. And you can see all those examples. Last, but probably most important on this slide, strategy. We are going to initiate a Bitcoin security program that coordinates with the global cybersecurity community, the global crypto security community, and the global Bitcoin security committee in order to help and contribute to consensus and solutions to address the quantum computing threat, as well as any other emergent security threats that evolve. We think it's reasonable and appropriate for us to do this, given our large responsibility as a Bitcoin holder. But we want to do it in a very responsible fashion, and we want to make sure that we coordinate with the global cyber, crypto, and Bitcoin security community, because there are a lot of very, very brilliant minds here. There's a lot of good work being done, and it's likely that consensus will form and solutions will form at the right time in a responsible fashion.
Yeah, so I think again the fact that Saylor was addressing this question of security against quantum computing is telling again of I think the conversations he's having off camera with investors, people that are concerned about this. I think that in the Bitcoin space, I may be incorrect in saying this, but I think people have been a little bit flippant, a little bit hand wavy, saying, "Hey, this is something that." Will sort itself out. And, again, perhaps to Saylor's point, this is a threat that might drive itself into a ditch. But I think this is also a departure in that Saylor historically has said, Bitcoin is this absolutely immutable base layer that is unchanging, perpetual, and something that we don't want to mess with. If it ain't broke, don't fix it. But to me, this was actually a little bit of a departure from that, saying that Bitcoin could become stronger. That is again, I guess, an adage of his saying stronger. Like Bitcoin is stronger, faster, harder, smarter, etc. The cyber hornets, etc. But yeah, to me, this was a departure. So Pierre, I'm curious, what was your read on this, and what kind of activities do you think we might see down the road as it relates to strategy getting involved in the Bitcoin development space?
Yeah, so I mean, I do think that the amount of quantum conversation has ticked up a lot, even outside of Bitcoin. So there have been fundamental advances that could be cause for kind of long term concern, and then combine that with there's a lot of competitors to Bitcoin that have implemented already post quantum cryptography hardening, and so they use it as a talking point of their chain is more secure than Bitcoin, and et cetera. So I think that what stood out to me from Saylor's response was about Bitcoin's history, and I think that it's really important to unpack what that history is and show. I actually think that if we look at that history, it perfectly validates what Saylor is putting forward here, in particular with the block size limit. So many moons ago, 10 years ago, actually it's now more than 10 years ago. Let's say 12, 13 years ago. We're getting old, we got a receding hairline, gray hairs. There was a sense of urgency created by a certain percentage of the Bitcoin community who said that we have to raise the block size limit. Otherwise, we're going to cause Bitcoin's adoption to grind to a halt because more people won't be able to adopt it. Right? It's just simple math that you need to increase the block size limit. And that not doing so is actually the experimental path, right? And that the conservative path is to increase the block size limit to not change Bitcoin's adoption economics. They made a very rational, plausible case for why you could safely increase the block size limit, right? So they did lots of simulations showing, we could do 10 megabyte blocks, we could do 50 megabyte blocks. Some people even said we could do 100 megabyte or 1 gigabyte blocks. Right? So they did a lot of due diligence on this, and highlighting kind of the advances in networking capabilities as well, right? So while Satoshi probably wrote Bitcoin with a DSL connection, probably not dial-up, right? Probably DSL. He didn't know about, and he had a Pentium 4. He didn't know about all the advances that would happen other than Moore's Law, right? Which says all these advances will happen. And that today we have the capability to raise the block size limit, so it should be uncontroversial. So they got all of the 90% of the hash rate, all right, all the big Bitcoin miners at the time they were in China. They got all of the big businesses, right? The New York agreement, Barry Silbert, Brian Armstrong, just all of kind of the blue chip institutional, players, and they all agreed to increase the block size limit. And what happened is that the block size limit was not increased. Instead, we had a SegWit soft fork that kind of transformed the block size limit into the block weight limit. And there's been criticism of that, right? There's very credible arguments for why that was inappropriate as well. And I was just doing some data analysis the other day, actually, on transaction fees. Bitcoin transaction fees have never been lower, meaning that Bitcoin has a tremendous amount of excess capacity throughput, right? So when people talk about, oh, Bitcoin only does X transactions per second, that's true, but the demand for Bitcoin transactions currently, from an empirical perspective, is far less than X TPS, right? So it was wise for the Bitcoin community to not rush into a block size limit increase. It was wise for them to soft fork SegWit in order to enable Lightning and fix the transaction malleability problem. It was wise for them to soft fork Taproot in and improve the cryptography from ECDSA to Schnorr. Although interestingly, there's quantum vulnerabilities that might be there, but there's also quantum hardening that is there. And so I think that each upgrade in Bitcoin's history is kind of built on lessons learned, and that overall there's been a pretty good balance between rushing upgrades through versus taking too long to upgrade them. And so I think that the history is actually it validates what Saylor's saying here as to what we should do with quantum. At the same time, he's right to invest in the software development that and kind of the protocol research or the crypto research to keep pushing the ball down the field, right? Because I can sit here and say it's inevitable that quantum will be solved, but I could also say, for example, that it's inevitable that a FIFA national soccer team would beat a Pee-wee kids team at soccer, but they still have to go out on the field and score goals, right? They can't just sit on the benches and let the kids score goals on them. So I think that it's like, yes, this is a solvable problem, but yes, we also have to solve it, right? We can't just sit on our hands and pretend that the code will write itself, or I'm sorry, that the LLM prompts will write themselves. We still have to code generate and problem solve and do, a lot of the cryptography is like really advanced math. And what I've been hearing from kind of at the cutting edge of AI research is that AI is about to get really, really good at advanced math. And when it can do that, I think that the Pandora's box of magical things you can do with cryptography, kind of that green field, is going to increase beyond what people can expect today. So that's and so it's great that we're going to invest resources into that because it's going to be extremely productive. It's not going to be like a multi-decade death march to write 500,000 lines of code or something like that, or that we have to pay the world's best mathematicians to come bail us out. No, I think that there's a really optimistic path here. The pessimistic path is about Satoshi's coins, right? So, hey, let's say we fix Bitcoin going forward, but how do we move the coins to more secure contracts, or do they get stolen by a quantum computer? I don't know. I think that first of all, I push back on the idea that it would be theft. There's lots of kind of common law principles going back millennia about, hey, if you stumble across a treasure chest full of gold, is it yours or not? Right. And because obviously this has been happening since the dawn of time. And I think that it's actually the correct metaphor from a legal perspective to apply to old coins that get quantum broken, or whatever, however you want to what terminology you want to use, quantum mined. then different jurisdictions are going to have different laws. So in some places, if your quantum computer gets the Bitcoin, those Bitcoin belong to the state. And same thing applies to you finding a treasure chest in your backyard. You might think it's your property. It's not, it belongs to the state. How are they going to enforce that? I don't know. Like other jurisdictions, you can keep it. You got clean title. So, I think that, and then in others, like maybe you have to make a good faith effort to find who the correct owner is and to like give them 50%, you keep 50%. Lots of legal systems have had different philosophies and practices around what to do in that scenario. So I think that that's where that question lies, not at the Bitcoin protocol level. It's not on us to decide if we should lock the Bitcoin, freeze them, unless there's a really elegant solution where we can kind of lock the Bitcoin, but not perpetually, right? So that there's kind of an opportunity for the correct person to come claim it later, some kind of cryptographic magic that a future AI will come up with. But as it stands today, I think it's mostly a legal question, not really a protocol question.
Yeah, and I think that the underlying legal question I find really interesting is what is the difference between ownership and possession? And when it comes to Bitcoin, if you have those 12 words, you do indeed possess the Bitcoin, but do you have a legal right to ownership? And I think something that is conferred by the state. And at the end of the day, too, it is I think exciting that Bitcoin itself, given Satoshi's coins and potential future valuations, is a pretty attractive bounty on quantum computing research. So in that way, it's driving forward technological advancement to perhaps some enterprising young minds, depending on their legal jurisdiction. And I think the last piece that I want to discuss when in reviewing this earnings call is we've talked about what's going on inside of strategy, kind of the developments around quantum going on outside of strategy as a risk, and I think another risk that today I don't think is particularly significant, but may grow, is what products are being built on top of Strategy's perpetual preferred equity. And this is something that Lynn Alden asked during the earnings call. So I'm going to go ahead and play that clip for us shortly.
For the next question, I would like to invite Lynn Alden from Lynn Alden Investment Strategy.
Thank you for the opportunity. Given the popularity of STRC, my question is focused on that. The company established that USD reserve, which I think shored up the confidence of these products and make them more attractive. Right now, the USD reserve is on the website 30 months of coverage compared to the dividends of the preferreds. The other preferreds are fixed dividends. STRC is a variable dividend, which introduces some degree of uncertainty around how many months of coverage there are for the total amount of dividends payable. Do you have any kind of views on what you think is an appropriate minimum reserve relative to months of dividend coverage? Or do you have a kind of a maximum that you'd be willing to pay on a dividend for STRC? And then a related question is, we are seeing some kind of early financial products that are out in the market that are looking to potentially leverage STRC, given the goal of low volatility and high yield. Are you monitoring the space for leverage built on top of that as it could contribute to spikes of volatility should there be an issue in the market? And do you have would you encourage that kind of thing, or would you dissuade leverage from building on top of that increasingly kind of a popular product? Thank you.
I can start, Lynn. Thanks for the question. First, we said that we target 2 to 3 years of dividend coverage with our US dollar reserve. So we wouldn't want it to go below 2 years. I think 3 years would be pretty high. And as far as whether we think there's a cap to the stretch rate, we're pretty early on, and we're sort of trying to understand what happens every single month at the end of the month. And that's why we have our guidance that we have, right? It's at 11 and a quarter. Could we take it to 12 potentially? But it's going to be a function of how do we keep the price within a tight range right around that $100, and also a function of what happens to interest rates in general. But I don't think we have a cap right now. We're just going to have to see how this instrument plays out over time. So that's the answer on stretch overall. And your second question, remind me?
The second question was around we're seeing kind of early products potentially looking to lever it up for other customers. Do you perceive issues in that? Are you monitoring it? Would you encourage or dissuade that type of activity?
I think anytime people create products on top of Stretch, right? There's some products that we've seen like Buck that have been issued that are, they're not levered products, but they're actually reducing the volatility down to about zero. And they're actually showing daily accruals as opposed to monthly accruals. So I think those are positive. I think to the extent people are going to build levered products, one, we can't really, we're not going to stop them. And I think leverage adds liquidity, adds a certain extent interest in Stretch. And we'll see how it plays out over time. But I don't necessarily think that's a bad thing.
Thank you for the clarifications.
Yeah, so I think Fong's response was quite interesting, saying, "Hey, that's something that we're keeping an eye on, but we're not necessarily going to discourage leverage on things like STRC." And he actually had positive things to say about some of the products that have been issued to date, where they're actually reducing the dividend payment and reducing the volatility for people that want, an even lower vol STRC like instrument. But Pierre, did you have any takeaways from Lynn's question? And I also would like to kind of look ahead and think, where will this go? Are we going to see tokenized like derivatives of STRC? And what are kind of the risks or failure modes or even benefits of this type of activity?
Yeah, absolutely. So, already today, hypothetically, somebody can go out and borrow against STRC. And if they're borrowing at an interest rate that's lower than the dividend rate for STRC, then they're capturing a spread. So already today, I think that there's probably I don't know how many dollars are doing this right now, but I imagine that's the kind of activity that some people might find interesting. Going further, though, I think what Lynn's pointing to is the development of kind of digital credit backed stablecoins, right? So if we look at stablecoins today, for example, Tether, they're backed by a combination of U.S. Treasuries that pay 4.5%, I guess, right, based on where interest rates are today. And then I know that they have like a mix of Bitcoin and gold and other collateral as kind of a top up on that. But really, their main cash cow is the U.S. Treasuries that generate a massive amount of cash flow for them. For Tethers, and that that has been kind of the success of the stablecoin business model has been capturing that spread between the stablecoins that currently don't pay any yield. That's being debated, right, in the regulatory legislative process, but because they're not paying any yield and they're capturing the yield from the asset they're backing the stablecoin with, that is very lucrative. So the thought experiment, and I think that what some teams are pursuing as a project, and we'll see how it unfolds, would be, okay, instead of holding, analog, old school credit that pays 4.5%, what if the stablecoin issuer actually held digital credit? The risk, obviously, is what happens if Bitcoin crashes, STRC goes to 70, for example, and there's stablecoin redemptions, and then your reserve is not fully backing. And so now you're in a deficit and your vehicle is insolvent, basically. And so it becomes kind of a risk management question, a probabilities question, because you could say the same thing about, for example, with Tethers, you could say, well, what if the government goes to Cantor and seizes the brokerage account, right? And that the stablecoin's not backed by anything anymore. So you can think of all sorts of different kinds of scenarios where a stablecoin breaks. And that, I think, is why stablecoins are not in the same bucket as Bitcoin. They're centralized, okay? But they have a completely different use case than Bitcoin because, again, a lot of people would rather have a stable form of electronic quasi cash, right? It's still a debt instrument. They still, it's an IOU from Tethers, but it's certainly a lot easier to spin up a stablecoin wallet than to open a bank account, especially for US dollars, especially if you're abroad, right? So I think that there's going to be continued demand for stablecoins. And then the question is, okay, how aggressive can the issuer be before they're kind of creating structural problems for themselves and for the market and for the stablecoin issuers? The other thing would be that, so what happens if a stablecoin issuer goes bust and has to liquidate all their STRC, for example? Let's imagine they grew their deposit base to be like $10 billion. And suddenly they're having to sell $10 billion worth of STRC into the market. That's where I think that strategy would probably be thinking about doing a buyback, right? If STRC is trading at $70 or $50, they might have other levers to pull, whether it's the dollar reserve or like selling Bitcoin, they or derivatives or whatever it is. So I think that's kind of the systemic problem you could get to with the strategy central bank would be that, right? So I think that we're so far away from there being these products out there. Like, I don't know of any stable coins that are currently backed by STRC. And then even when they do exist, they've got a big uphill challenge, which is the network effects that Tether's has. Circle has tried to compete with Tether, and they haven't really done a material, taking of the market share. They might have helped grow the market share, but I think that there's other challenges other than just what's the collateral base. What we could see happen would be Tethers themselves saying, hey, we're going to sell some of our treasuries and we're going to buy digital credit products in order to increase our yield for our portfolio of assets that are backing Tethers. That we could see happen, and obviously they would have to be very careful about how they go about doing that. Maybe they wait for their affiliated 21 Co to come out with similar digital credit products so that they're feeding their business, and keep an eye out on that.
Yeah, I was doing a little bit of research, and it looks like there is something called Buck Token that is a STRC backed stablecoin paying 7%. And
Interesting, yeah.
I think that's what Lynn was referring to in this call. So just kind of looking at the total flows into it, I think it's pretty much a drop in the bucket. And at the current point in time, is certainly not anywhere close to a systemic risk. But I think the thought experiment certainly is valuable. Is what could this do to the volatility of Stretch? But to your point, they've raised this cash buffer. They've signaled that, hey, we are open to liquidating Bitcoin, doing stock buybacks, doing buybacks of the perpetual preferred equity, I think, to head off those risks. So, I guess the theme of today's episode has kind of been the Bitcoin market stress test. And I think that would be, again, just purely for me, like an entertaining stress test, and just seeing how their management approaches that.
I want to add one more point that you just reminded me of, which is that if Stretch were to depeg and go down to like $70, that means that strategy doesn't even have to raise the yield, because the implied yield increases, right? Because it's multiplied on the $100, not on the $70. And so you could see the implied yield go, far higher than it is today, and really attract a lot of investors who could say no to that level of returns. So I think there's a lot of things that are built in that are anti-fragile, and that the model will continue to, obviously they're still learning, right? I mean, they added the cash reserve this quarter, and so I think they'll continue hardening it and adding different features. But already it's really impressive what they've built.
Yeah, and I think looking ahead to the next quarter, the strategy's credit rating, I think, is going to be the thing that I really want to be watching going forward, and seeing how other Bitcoin-backed credit instruments perform. I think SATA that you mentioned with Strive is going to be very interesting, and I think 21 is another one to watch, kind of working with Cantor, kind of at the core of the bond market. I think is I think that's going to be a really, really huge signal for the broader, institutionalization, financialization of Bitcoin. So, trends to look forward to, I think, over the next few quarters and years. I guess, I think we've covered a lot of ground here, Pierre. Do you have any final thoughts, anything we didn't discuss with regards to the earnings call? And certainly, there'll be more to discuss in future episodes of the Bitcoin for Corporations show.
Yeah, of course. And so, hit subscribe, right? Subscribe to Bitcoin for Corporations. You can follow me on X at Bitcoin Pierre. And also to remind folks, there is a Bitcoin for Corporations event coming up in Las Vegas that is a part of Strategy World. And so if you haven't bought your tickets, booked your hotel, booked your flight, there's still time. But the clock is ticking because it is in 2 weeks.
Yes, February 24th and 25th in Las Vegas. I think last year's Bitcoin for Corporations conference, I thought there was just so much amazing content. And I think this year will be no different with, again, the growth in the space that we've seen over the last 365 days. So we'll see you there in Las Vegas. And yeah, look forward to it.
Yeah, likewise. Thanks, Spencer.
Alrighty. Thanks, Pierre. Talk to you soon.